The opening bell on April 4th, 2025, signaled more than just the start of a trading day. It marked the beginning of a deepening trade war between the world's two largest economies. Investors watched in disbelief as the S&P 500 plummeted, a stark reaction to China's aggressive retaliatory tariffs on US goods. Fear and uncertainty gripped the financial world. The S&P 500, a key indicator of the US stock market's health, tumbled by over 3%. This dramatic drop erased billions in market value. The Dow Jones Industrial Average followed suit, plunging by over 1,000 points. The tech-heavy Nasdaq Composite suffered an even steeper decline, losing 3.5% of its value. European and UK markets mirrored the downward trend, reflecting the interconnectedness of the global economy. The markets were bracing for a trade war. The tariffs, announced just hours earlier, were far-reaching. They targeted a wide range of American goods. The speed and force of the market's reaction underscored the high stakes involved. This was not just about economics, it was about geopolitical power and the future of global trade. China's response to the latest round of US tariffs was swift and decisive. It announced a 34% tariff on all US goods, mirroring the US increase on Chinese imports. These tariffs, set to take effect on April 10, 2025, were carefully calculated. They were designed to inflict maximum pain on the US economy. These retaliatory measures were not unexpected. China had repeatedly warned the US against escalating the trade war. However, the sheer scope of the tariffs surprised many analysts. They covered a vast array of products, from agricultural goods like soybeans and pork to manufactured items like cars and machinery. The message was clear. China was prepared to weather a protracted trade war. This tit-for-tat exchange of tariffs marked a significant escalation in the ongoing trade dispute. It signaled a new phase in the conflict, one with potentially devastating consequences for both sides. This trade war had the potential to derail the fragile recovery and push the world into recession. The stock market is often described as a barometer of investor sentiment. On April 4th, 2025, that barometer pointed to a perfect storm of fear and uncertainty. The S&P 500's plunge was not an isolated event. It was a symptom of a broader global market meltdown triggered by the escalating trade war. The Dow Jones Industrial Average, another key US stock market index, mirrored the S&P 500's downward trajectory. It plummeted by over 1,000 points, a drop that wiped out trillions of dollars in market value. The Nasdaq Composite, heavily weighted towards technology companies, suffered an even steeper decline. These losses reflected a widespread sell-off across all sectors of the market. The turmoil was not confined to US markets. Stock markets across Asia and Europe also experienced significant losses. European markets, heavily reliant on trade with both the US and China, were particularly hard hit. The banking sector, already grappling with low interest rates and increased regulation, was particularly vulnerable. China's response to the escalating trade war was not limited to tariffs. It unveiled a multi-pronged strategy targeting specific US industries and companies. One potent weapon was its unreliable entities list, targeting foreign companies undermining Chinese interests. In response to US tariffs, China added 11 more US companies to this list. This could disrupt supply chains and limit market access. China also imposed export controls on 16 US companies. Additionally, it restricted 7 rare earth minerals essential for high-tech products. This move demonstrated China's leverage in the trade war. The escalating trade war between the United States and China highlights a long-standing trade imbalance. The US imports significantly more from China, resulting in a large trade deficit. This imbalance has caused tension, with the US accusing China of unfair practices. In 2024, the US trade deficit with China reached $279.1 billion. The US imported $426.9 billion from China, exporting only $147.8 billion. This reflects the different structures of the two economies. China specializes in manufacturing, while the US is more service-oriented. The trade imbalance remains a contentious issue. The US argues China's practices give its companies an unfair advantage. The trade war has led to tariffs to reduce the deficit. The escalating trade war between the United States and China was accompanied by a war of words. Political leaders on both sides exchanged barbs, accusing each other of protectionism and unfair trade practices. The rhetoric raised concerns about deteriorating bilateral relations. The US defended tariffs to protect American jobs and businesses. They accused China of currency manipulation and intellectual property theft. China criticized the US for protectionism and unilateralism. The international community condemned the escalating trade war. The WTO expressed concerns about the tariffs' impact on the global economy. Other countries urged the US and China to resolve their differences through dialogue. As the trade war between the United States and China escalated, economists and analysts painted a bleak picture of the potential consequences for the global economy. The consensus was that the tariffs would dampen economic growth, disrupt global supply chains, and increase prices for consumers and businesses. The uncertainty created by the trade war was also seen as a major risk factor, discouraging investment and hiring. The International Monetary Fund warned that the trade war could shave up to 0.8% off global GDP by 2025. The IMF also expressed concerns about the impact of the trade war on business confidence and investment, which could further dampen economic growth. The Organization for Economic Cooperation and Development echoed the IMF's concerns. It warned that the trade war could trigger a global economic slowdown, with negative consequences for employment, investment and living standards. Financial institutions also sounded the alarm. Goldman Sachs warned that the trade war could push the US economy into recession. JP Morgan Chase lowered its global growth forecast, citing the trade war as a key risk factor. The escalating trade war between the United States and China not only threatened global economic growth, but also raised concerns about inflation. Tariffs, by their very nature, increase the cost of imported goods, which can lead to higher prices for consumers and businesses. This inflationary pressure could force central banks to raise interest rates, potentially slowing economic growth even further. In the US, the Federal Reserve was already facing pressure to raise interest rates to combat rising inflation. The trade war added to these inflationary pressures, potentially forcing the Fed to raise rates more aggressively than previously anticipated. Higher interest rates could make it more expensive for businesses to borrow money and invest, potentially slowing economic growth. In China, the central bank was also grappling with the potential inflationary impact of the trade war. China is a major importer of commodities such as oil and soybeans, and the tariffs imposed by the US made these imports more expensive. This could lead to higher prices for consumers and businesses in China, potentially fueling inflation. The spectre of inflation was a major concern for policymakers and businesses around the world. The escalating trade war between the United States and China cast a long shadow over the global economy. It marked a turning point in the post-World War II era of globalization, which had been characterized by increasing trade liberalization and economic integration. The trade war raised fundamental questions about the future of global trade and the rules that govern it. One of the most significant consequences of the trade war was the erosion of trust between the United States and China, the world's two largest economies. The trade war had damaged the bilateral relationship, making it more difficult to address other global challenges such as climate change, pandemics and nuclear proliferation. The trade war also accelerated the trend toward deglobalization, with countries becoming more inward-looking and protectionist. This trend was driven by a number of factors, including the rise of populism, concerns about job losses due to automation and trade, and a desire for greater national self-sufficiency. The trade war exacerbated these trends, making it more difficult to reverse course. The future of global trade remained uncertain. The outcome of the trade war between the United States and China would have far-reaching consequences for the global economy and the international order. So what are your thoughts? I would love to know them, so be sure to comment below. Also, don't forget to like, share and subscribe. Thanks for watching.